In today's video, I'm going over the 4 questions you must answer if you want to retire. After years of being a financial planner, I've heavily relied on these questions to help my own clients comfortably retire. And to make sure there's no second guessing as to when you can retire, these 4 questions will guide you in that decision-making process. And that's exactly why I'm making this video. I'm going to reveal what these 4 questions are, what makes them so important, and how you can use them to determine if you're finally ready to retire. Let's get right into it. It's important to understand that investing for distribution in retirement is way different than accumulation, right? And in fact, there are a bunch of viable competing strategies for retirement income. And if anyone is telling you there's only one way and it's the best way, well, they're probably selling something. So the 4 questions I'm going over in this video are based off the RISA framework, the Retirement Income Style Awareness Matrix, right? The understanding that there are different preferences for income in retirement. There are those who are okay with a probability-based retirement income plan where they are using total return, right? Asset allocation and accepting the equity risk premium that over long periods of time, stocks outperform bonds and using that asset allocation to drive their income in retirement, right? And that maximizes optionality and can be good for legacy planning, right? Now, the exact opposite and the most common preference actually is that safety first committed approach to retirement income. Hey, I can make the decision now. I don't have to worry about it for the rest of my lifetime, which can protect myself from cognitive decline, or if I have a spouse that would not be comfortable managing the decisions when I'm not here, right? Some people like that preference to have lifetime income, maybe in the form of an annuity, or if they like optionality, they may like the time segmentation approach of bond ladders, so knowing exactly how much cash to expect from a maturing bond, right? But still giving them that safety first income in retirement. That's okay. So different people have different preferences, and that's okay. The point of this video is to help you understand where you fall and help you feel more confident in your retirement income planning. Question number 1. Have I used Monte Carlo simulations and other probability-based methods to explore a wide range of outcomes for my retirement portfolio? All right, why is this so important? You are about to make a weighty decision. This is not the time to use ballpark math. If you're really seriously considering stepping away from work, you want to look through not just historical averages, but you want to look at the best case scenario, the worst case scenario. We don't know what the uncertainty will look like, but there is inevitable uncertainty in the future. If we look historically, when was the worst time in recent history to start your retirement, to start a 30-year retirement? Well, it was the 1966 retiree, right? And in fact, that's what the SafeMax 4% withdrawal rate was based on, that even if you were the unluckiest of individuals and retired in 1966, where over a 30-year period, market returns were actually okay. However, the early part of your retirement, market returns were pretty bad, right? And they call this the sequence rate of return risk, right? If you have a bunch of down years in the market right when you retire, it can impact the terminal value of your portfolio over your retirement. So anyways, that's a scenario that you want to account for. Like, if that were you, are you still okay to retire based on your current reality? It's a tool that can help put your mind to ease, where we can stress test what if market returns going forward aren't as nice as they have been in the past? Or what if you're worried your Social Security benefit may be lower than what you were expecting, right? And we can run those stress tests and still look at and give you the reassurance, hey, even if this were to happen, you are still good. Or, hey, if that were the case, you may have to be willing to adjust your income. Now, before I move on to the next question, I know that some of this information can get a bit complex. So if you're unsure about anything I'm talking about in this video, I'm offering you a complimentary call where we can sit down one-on-one and discuss your retirement plan. Just click the first link in the description to schedule. Question number 2. Have I built a secure component into my retirement plan, such as pensions, annuities, or Social Security, that guarantees I can cover essential expenses regardless of market fluctuations? Now, why is this important? Well, if we go back just 2 years, right, to 2022, when the stock market and the bond market were both negative, you didn't have a safe place in your portfolio to pull money from, right? Stocks were down 20%, bonds were down 10%. If you're going for that total return approach, that's why it's important to have a cash reserve, right? So you aren't forced to sell an investment when it is down. Anyways, without a cash reserve, without this secure income, like there may be years like 2022 where stocks and bonds are both down that you have to sell an asset that's down for your income, right? And that is uncomfortable. So even for those retirees who have that safety first preference for retirement income, a lot of times they're just doing that to cover their non-discretionary expenses, their needs, and then they're using their stock portfolio for their long-term growth and legacy goals, right? Like that's okay. You can combine some of these strategies. That's why, in my opinion, the time segmentation is such a good mix of that safety first committed approach of income protection and that optionality probability based approach of a total return portfolio, because in the time segmentation quadrant, you still have maximum optionality. Like you still can sell bonds. US Treasuries are very liquid, right? You can find a buyer for your US Treasuries. But if you build out this bond ladder, you know exactly how much cash to expect. So you're not forced to sell something when it's low. You just hold it to maturity and you've planned on that. It's called liability immunization. So you've planned on having these bonds mature when you need that cash. But behaviorally, this has now allowed you to segment your stock portfolio as long-term money, right? So again, back to 22, that example where stocks and bonds were both down. Well, with a time segmentation approach, that didn't impact you as much because you had a bond set to mature with that cash there to take care of your income need. And that allowed you, hey, yes, even though it is uncomfortable when the stock market is down 20% or more, behaviorally you said, hey, I don't need this money for 7, 10, 15 years, which is why I'm okay that it's down right now, because I know in 10, 15 years it's going to be higher than it is today, right? So behaviorally, that time segmentation is a huge win. And in fact, it can be pretty similar in the returns of a total return portfolio, because you're still holding, similar assets, stocks and bonds in there. Question number 3. Have I incorporated optionality into my retirement plan? Meaning, have I built enough flexibility to adapt to changing circumstances and seize new opportunities? This is important. Now, this is a preference, and the opposite of this preference would be a committed approach to your retirement income planning. And some people do like a committed approach to their income planning for a few reasons. The most two common reasons that I see are if they're worried about cognitive decline and they want to make a good decision now while they're in sound mind, or 2, they're worried that if they were gone, their spouse may not be able to manage this money comfortably, so they want to make that decision for both of them over their lifetime, while they are of sound mind to do so. So plans change, right? In fact, as a financial planner, one of my favorite quotes that describes the role of a financial planner is that they are guides in changing landscapes, right? Like, this is not a set it and forget it one-time financial plan. Like, this is a living, breathing document. The process of planning is more valuable than the plan, right? Because we know there is inevitable uncertainty. We know the future will look different. We just don't know how, right? So optionality gives you that flexibility to make adjustments as needed, right? As life changes. One of my past colleagues used to work for a financial service company that primarily only sold this income protection products, these annuities or other insurance products, right? One of the attributes of these insurance products to solve these income preferences in retirement is that it is a committed approach. And if you deviate from that, there could be a financial penalty or a surrender charge for doing that. And so, this particular colleague, didn't like the approach of the company where, their only tool was a hammer, so every problem looked like a nail. And so then he went to the complete opposite spectrum, that total return approach to financial planning, the optionality and the probability-based approach of retirement income. And that was one of the things he would tell people is like, look, I'm here to help you. And if you don't like it, like, you can leave. You're not tied into a contract or a surrender charge or a penalty, right? So again, I guess I use that as example to highlight, what is optionality, that you have the flexibility to make changes. You're not tied down to anything or locked into anything. And some people like that optionality. Before I reveal the last question, I hope you know that there's a lot more that goes into transitioning into retirement, such as withdrawal strategies, Social Security timing, and even tax efficiency. And that's why I routinely make these videos so you have everything you need to retire. So to ensure you don't miss anything, click the subscribe button. Now on to the last question. Question number 4. Am I treating my retirement strategy as a continuously evolving process, regularly reviewing and updating my plan rather than relying on a one-time setup? This isn't even just singular to financial planning. There are a lot of life topics that fall into this, right? The consistent, the regular, the steady review instead of, front loading everything and then never have to worry about it again. Like brushing your teeth. You can't brush your teeth for 30 minutes on Sunday and then think you don't have to brush your teeth the rest of the week, right? 2 minutes morning and night is way better than 30 minutes once a week, right? This is super important. Now, there is a ton of value in doing a one-time financial plan, right? Getting clarity about why money is important to you. What are your goals? And where are you financially today? What is your current financial reality? Like, there is value in doing that. That is definitely a starting point. However, the process of planning is way more valuable than the plan in and of itself, because the plan is wrong the second you leave. It's like brushing your teeth and then the plaque immediately starts to build, right? Because when you're building this plan, we're using assumptions in this plan that could be wrong tomorrow, right? They could be wrong as soon as you walk out the door and markets change. Yes, it is valuable, but the process of adjusting these plans through uncertainty, through inevitable uncertainty, through these changing landscapes, that's the real value of financial planning. Market conditions are constantly changing. Goals can be changing. Health can change. Work circumstance. There's all these things that are just, in motion, constantly in motion. And so being able to process all of that and distill it and to what are the most important things to focus on right now? Are you still on track? Are there any adjustments that need to be made to help you reach your goals and prevent you from running out of money? I am saying the process of planning and proactively and regularly staying on top of this is absolutely worth it. However, I am not saying to be consistently logging into your 401k balance and checking it daily, or following financial news every single day, because then that's probably preventing you from living your rich life and doing the things that you want to do with the people you want to be with, right? And in fact, if you feel like that is you, right, where you're the person where you are watching the news every single day, you're checking your 401k balance, and the moves in the market can either make you happy or sad on a daily basis. Well, let me tell you this. Half of the days the market is negative, and nothing is wrong, right? Literally, almost half of the days in the market are positive and half of them are negative. Over long periods of time, we know that the market trends upward, right? So literally, if you're checking it daily, you could be worried when literally nothing is wrong. At a minimum annually. For some, they may feel more comfortably semi-annually or quarterly. Or maybe it's even just a monthly check-in with your spouse, just being on the same page. Hey, here's where we are. I don't know, whatever it is. As you can see, these 4 questions are absolutely necessary to answer if you want to retire with confidence. However, I hope you understand that there is a lot more that goes into transitioning into retirement that I don't have time to cover in this video. So to make sure you're checking all the boxes and timing your retirement correctly, I'm offering a complimentary one-on-one call. In this call, I'll measure exactly where you stand and give you the advice to help you retire on time. To book your call, just click the first link in the description, and I'll see you in the next one.